Today's episode is sponsored by Land Gorilla, the premier software for managing renovation and construction loans. Let's face it, renovation loans can be messy, but your draw management shouldn't be. Land Gorilla brings draw requests, disbursements, change orders, and project data all into one single experience. The platform eliminates communication gaps so you can deliver faster draws and scale your pipeline safely. Learn more at landgorilla.com. Imagine this. A borrower calls because they finally found the fixer-upper they've been dreaming about. They already know the flooring they want, they've picked out the kitchen cabinets, they're excited about those quartz countertops they've always wanted. Mentally, they've already moved into the house. Meanwhile, you're sitting there wondering, what in the world do I do now? What do I say? Maybe you've attended training, maybe you've read all the program guidelines, and you've been promoting renovation loans for a few weeks, but this is your very first renovation lead, and suddenly your mind goes blank. You completely freeze. We've all been there. In this episode, I'm going to give you a roadmap so you know exactly what to say when you get this call, what questions you should ask first, how much information you should give them. I'll walk you through the conversation I believe every loan officer should have with renovation borrowers, not to impress them or overwhelm them with guidelines and requirements, but to eliminate surprises and keep their renovation loan moving smoothly from loan application to project completion. Before you talk about loan programs, you should understand the project. One of the biggest mistakes I see is loan officers jumping straight into loan programs and guidelines before they even understand what the borrower is actually trying to accomplish. I didn't start conversations by explaining how FHA 203K loans work, or Fannie Mae Homestyle or Choice Renovation. You pick your renovation program. I began by asking questions. Take note, because these are the questions you want to ask when borrowers call you and tell you they want to finance a fixer-upper. If it was a purchase, I wanted to know, are you already under contract? What is the purchase price? What improvements are you hoping to make? How much do you think they will cost? And has your real estate agent talked to you about what the home might be worth after renovations are completed? Notice what I didn't ask for, a contractor's bid or exact numbers. At this stage, verbal estimates are perfectly fine. We're just simply trying to understand the project. Now, if it was a refinance, my conversation changed slightly. I wanted to know, how much do you owe on your home? What improvements are you looking to make? How much do you think they'll cost? What do you think your home is worth today? And what do you think it'll be worth after the renovations are completed? If they didn't know, that was okay. I'd encourage them to do some research because that future value, that subject to value, is so very important. If you can determine whether someone is trying to over-improve a home for its area early in the process, then you're going to prevent yourself from spending a lot of time on a loan that's never going to close, and you're going to save your clients time, frustration, and maybe even money. The point is, before you travel too far down the path and recommend a loan program, you need to learn more about the property and the project. You're trying to discern, does this property qualify, and is this project eligible for financing? And if I may add a word of caution, remember to factor in county loan limits. After you've asked a few questions, you should be able to discern how much money somebody's going to need to borrow. And if they're butting up against the county loan limit, that's something they could benefit from knowing sooner rather than later. Let me share a conversation I've had hundreds of times. Years ago, I worked for a lender that specialized exclusively in renovation lending. Every morning, I'd walk into my Indianapolis office. I was on the 11th or 12th floor of the building. I would log into my computer, kick my feet up on the windowsill, look out over the city, and start returning calls of borrowers who had made renovation inquiries online overnight. For the majority of each workday, I had essentially the same conversation, over and over and over. Eventually, I realized something. The borrowers who had the smoothest transactions weren't the ones with the strongest credit package. They weren't the ones with the highest income, the most educated. They weren't even the ones who did a ton of research online before they called me and thought they had everything figured out. They were the ones who were teachable. They listened, they asked questions, and they trusted the process. It was during that time that I learned setting expectations wasn't just good customer service. It helped my team to close loans faster. It reduced surprises, and ultimately it helped my employer to manage risk. The goal here is to help borrowers understand the loan. Once I understood the project, then we would talk about financing. I explained that renovation loans allowed them to purchase or refinance a home and finance both the property and the improvements into one mortgage with one monthly payment. That was important because some people came to me with this misconception that they had to get financing for the home through one lender and work with me for the funds to renovate their property. I made it clear from the start they only needed to work with one person, me. Depending on the situation, we would compare the loan programs that they were eligible for, helping them to understand things like mortgage insurance, interest rates, cash needed at closing, and down payment requirements. One thing I always made sure borrowers understood, and I think it's important for every loan officer to clarify, down payments are based on the purchase price plus renovation costs, not just the purchase price. That's a surprise I'd rather avoid, and I'm sure you would too. I would also clarify which fees could be financed, like architectural and engineering fees, draw inspection fees, title updates, permits, and which ones they are likely to pay for out of pocket, like the costs of a home inspection, if they want to have one done, well and septic inspections, consultant fees, appraisal fees, and so on. And I would explain that while consultant fees technically can be financed, most consultants require payment at the time service is rendered. So very likely borrowers will have to pay consultants up front, but since those fees can also be financed, if they choose to finance them, they can get quote unquote reimbursed at closing. I hate to say reimbursed because really it's their money, they're financing it, but they can get that cash back at closing to reduce their cash to close. That was helpful on home purchases where buyers had limited funds. Remember our borrower at the beginning of the episode who found their fixer-upper, the one who had already mentally moved into the house? Well, let's imagine that their project is a large one. They're renting an apartment and wouldn't be able to juggle the cost of their rent plus their new mortgage payment while they're waiting for their house to be done so they can move in. With that buyer, I would explore the option to finance mortgage payment reserves. The next step is walking them through the journey. After we talked about financing, I shifted gears and explained the journey because borrowers don't just want to know what happens, they want to know when it happens, and they need to know what they're responsible for each step of the way. Renovation products like FHA 203K or Fannie Mae Homestyle loans are notoriously complex with strict compliance and escrow guidelines. Throughout my career, I've trusted Langorilla because their platform is purposefully built for renovation lending. It handles everything from detailed draw schedules to tracking escrow interest with total accuracy. Don't let compliance slow your business down. Streamline your renovation programs at Langorilla.com. So I walked them through it. For purchases, first comes pre-approval, of course, right? Once they found a home and their offer was accepted, then they'd select a contractor and obtain a bid. If it was required, at that point we would engage a consultant or order a feasibility study, and then we order the appraisal and work through underwriting, clearing conditions, closing the loan, and funding the loan. Only then can the renovation project begin. It's important to note that renovation work cannot begin before closing. I had to learn this the hard way once when I was unable to reimburse a borrower because they had started work prior to closing and it was no longer considered a hypothetical improvement per the appraisal. That's one of the most important expectations you'll want to set so you can learn from my mistake. This is where expectations really matter. Once borrowers understood the process, then we started talking about responsibilities. Let's go back to our fixer-upper buyer. I might ask if they plan to do any of the work themselves. The lender that I worked for didn't allow any self-help or DIY repairs, do-it-yourself repairs, so it would be important to clarify that distinction during our first conversation. Any contractor they hired would have to be vetted, and if all they qualified for was an FHA loan, they couldn't be related to their contractor. Their bid may need revisions, and trust me, it almost always does. Additional repairs could be required by the consultant, the appraiser, the underwriter. This is another expectation I learned to set the hard way. I once had a client who thought they could dictate which work items could be financed or would be financed because it was their loan and they would be making payments on it. I understood their logic, but we all know he who has the money makes the rules, right? It didn't matter how skillfully I tried to explain the guidelines or how loans get insured. He was upset and he wasn't going to get over it quickly. From that point on, I learned to plant this seed that there could be required repairs that need to be added to the bid. I planted that during the first conversation I had with borrowers, and I never again had to deal with a borrower that was upset, at least not for that reason. The fact is, projects, sometimes they have to be tweaked, and that doesn't necessarily mean that a loan won't close. It's just simply part of the renovation loan process. So why not set that expectation early? Next, we would talk about contingency reserves. I would always explain contingency reserves are designed as a cushion in case any unforeseen or unexpected repairs pop up during renovation. While I told borrowers how much would be financed for contingency reserves, I never gave that information to contractors. Never. Again, I had learned the hard way. If you tell contractors how much is in contingency, they will find a way to use it. And sometimes it's not in the best interest of the homeowner. Some loan programs allow a homeowner to dip into the contingency reserve for extra improvements. We call that discretionary use of the contingency. But other loan programs don't allow it, so I guided my borrowers accordingly, depending on which loan program they were using. And I explained if the money wasn't needed, it would generally be applied as a principal reduction. But if they had self-funded contingency and money was left over, we could give it back to them. The borrowers who could afford to self-fund their own contingency reserve really loved hearing that. Now I needed to explain the renovation phase. This is another time when expectations really matter. I always asked for 60 days to close. Not that I always needed that long. In fact, my career average ran about 42 days to close. But you never know how long it's going to take someone to find a contractor and get a bid, so I built in a nice cushion of time for that. And then I explained the rest of the timeline to them. No work can begin before closing. Permits must be obtained after the loan closes and before any work starts. Renovation needs to begin promptly after closing and definitely within 30 days. Work can't stop for extended periods of time, and every renovation loan program has different completion deadlines. They can range anywhere from 6 to 12 months or maybe even longer. Most importantly, I told homeowners not to change the scope of work without talking to us first and not to fire their contractor without calling us. Those two conversations alone can save borrowers enormous frustration. Moving on, I covered the draw process. Borrowers don't need to become experts, but they do need to understand that contractors aren't paid the same way they're used to. Funds are held in a renovation escrow account, draws are dispersed as work is completed, and the exact process depends on the loan program. Let's go back to our home buyer who found the fixer-upper. If they only qualify for FHA 203K standard financing, we wouldn't be able to give their contractor an upfront or initial deposit at closing, and that could be a deal breaker for their contractor. It would be much better to discuss that as early in the process as possible. No contractor should hear this for the first time after a loan closes. We'll dive a little deeper into draw administration in a future episode, but for now, you simply just want borrowers to understand why the money isn't sitting in the contractor's checking account on day one, or theirs for that matter. Let's talk about where things tend to go wrong. In my experience, renovation loans rarely fail because of the financing. They usually fail because expectations weren't set early enough. Borrowers hire the wrong contractor, somebody starts work before closing, the scope of work changes without approval, homeowners decide to tackle a project of their own before their contractor is done. Then the house doesn't pass the final inspection because there's ongoing construction on the premises and unfinished work. Or sometimes it's just a simple matter of miscommunication. Everyone assumes someone else is going to go obtain the permits or make a phone call or request a draw. Most of the problems are preventable, which is why these conversations matter so much. Here's a pause and think moment. Something I'd encourage every loan officer to think about. When borrowers leave your first conversation, do they feel confused or confident? Because borrowers don't need you to memorize every guideline so you can answer every question they have on the spot. But they do need someone who can confidently guide them through the process they've never experienced before. That's where your value comes from. I'd like to invite some listener engagement. I want to hear from you. If you're a loan officer, what part of the renovation process creates the most confusion for your borrowers? Is it the timeline, contractors, appraisals, draws, or something else entirely? Send me your questions or future topic ideas at jennifer@therenogal.com or leave me a message at 844-RENOGAL and follow the prompts. And if you've developed a great way to explain renovation lending to borrowers, I'd love to hear that too. Your experience might help someone else become a better renovation loan officer. In closing, the best renovation loan officers aren't necessarily the ones who remember the most guidelines. They're the ones who eliminate surprises, because when borrowers know what to expect, contractors know what to expect, and referral partners know what to expect, confusion gives way to clarity, uncertainty gives way to confidence, and everyone begins moving in the same direction. They understand their role, they understand the process, and that's what keeps renovation loans moving forward smoothly. In the next episode, we're going to continue this conversation, but from a different perspective. We'll shift our focus away from borrowers and talk about the conversations every renovation loan officer should be having with real estate agents and contractors, because setting expectations with your referral partners is every bit as important as setting them with your borrowers. Thank you for spending a part of your day with me. This is renovatED for Lenders. Thank you for listening to Renovate Ed for Lenders. This episode was brought to you by Land Gorilla. Deliver clarity to borrowers, contractors, and your operations team with the industry's most trusted draw management solutions. Visit landgorilla.com today.